It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal is to help cut through that noise to navigate the best moves for your portfolio. Today, we're examining your leisure spending dollars. Where are they going? Joining me here to discuss is James Demmert, Main Street Research Chief Investment Officer. Good to see you again, James. Thanks so much for being here. So let's get to the stock you do like first, and that is Booking Holdings. As we are still seeing people travel to some extent, the stock has done well over the past year. So let's get to your case here. And first of all, it starts with the growth and it starts with the profit margins, both of which are about 20%. So 20% sales growth, revenue growth, we're talking about specifically there, right?
Yeah, and 20% profit margin and a consistent profit margin, and which and a 20% grower of earnings. So those two consistent numbers are really one of the things that we think is so fabulous about this company. Based in Amsterdam, we're global investors, so we love looking at the US companies, but also these companies based in Europe.
Right, and of course, Booking also has a big business here in the U.S. as
Boy,
well, as well as globally, a lot in Europe as well. Now, there's a lot of places to travel to book your travel right now, right? But you say they have built a moat around the business model. Explain what you mean there.
They really have. You know, in the beginning when they started out, the big competition was that Google would get in the business, right. Amazon, right, with this tremendous amount of cash flow. And they tried, but they were unable. And over time, what's happened is Booking has just created what I call a moat, right? This sort of hard to penetrate market share. And the more they have this, the more it continues to be a stronghold. What's really interesting about, and I think what creates that moat, it's the ease of use of their web access. And now they have an AI trip advisor.
Of course they do.
This thing tells you where you want to go, what car you might have leased before, even your thread count of your sheets. I mean, it's really pretty amazing.
Wow, I like that filter. I'm going to have to click on that one the next time I book something. And then finally, there's the valuation that you're looking at as well. And, you know, that you are seeing that growth that you pointed out, but at what you say is a good valuation.
Yeah, I think, you know, here outside of AI and all that stuff, you want a consistent grower that's not a tech stock. This is a 22 times earnings, growing at 20% a year. I think it's just a really great, consistent part of any portfolio construction.
So as you know, we always like to talk about what could go wrong with the stock. And in this particular case, you know, you get another pandemic and travel stops. That's sort of something you can't control. Or if we do get more meaningful economic slowing, that could be a risk.
Yeah, that's really the risk. You know, anything that would cause people not to want to get out there and travel. But right now, that is not in the way. And hopefully it doesn't come in the way, certainly the pandemic.
Right, knock on wood, seriously.
Yeah.
And you are a holder of Booking.
Both my family and my firm, yeah.
Gotcha, okay.
We eat our own cooking.
Gotcha, well, it's good to know. Let's get to the stock you don't like. This one is quite interesting to me. It's Disney. This stock has also done well over the past year, in part as the proxy battle has been going on. But in terms of why you don't like it, the first reason is quite interesting to me. Bob Iger came back to the company, but you say some of the decisions made by his predecessor, Bob Chapek, took the company down such a wrong path that they can't be reversed. What are some of those concerns?
Yeah, and I think Bob Iger, right, he's just a fabulous manager and was there for so long. But I even think for him, it's too little too late. The previous manager dug a hole strategically and too much time spent and too much money spent that I'm not sure that Iger is really the right kind of turnaround guy here. Iger's great at building businesses and being creative. Now he's coming in basically trying to pick up the pieces and clean it up. I'm not really quite sure, and I don't think shareholders might be either. Of course, we have Nelson Peltz who came in, and that made it even more difficult. So management is the big problem there, and I'm a real stickler for buying companies with excellent management, with visibility. This is a bit of a mess when it comes to management.
And one of the messes you contend is what has happened with streaming and sort of the spending on content that the company has done. Is it not sort of paying off for them, do you think?
You know, it was a difficult, very competitive goal to try to compete with Netflix.
Yeah.
I mean, the monster, not just in the US, but globally. And that was really the whole strategic idea behind previous management. Let's make Disney this very competitive streamer against Netflix. It's just like sending the Cleveland Browns to play, the Kansas City Chiefs, if you're a football person.
Yeah.
It just has not worked. And the problem is, it doesn't look like it's it's going to work, and it's been very expensive and very time consuming. So that is sort of something I think Iger is going to have to wrestle with. And the question is, do they just cut their losses and move on, or they try to turn it around?
Yeah, I mean, he has sort of tried to trim down the spending, but you don't think he's gone far enough?
Again, too little, too late, I think is the problem there.
And then valuation, just like we talked about with Booking, you think this stock is overvalued?
Yeah, it's growing at 5% a year, right, compared to Booking at 20, but it's trading at 25 times earnings. And typically you want to have PEs equal to the growth rate. So 25 times earnings and growing at 5% is far, far away. So that valuation proposition doesn't make any sense to us.
So what could go right for Disney? And you pinpointed two things that could potentially go right for Disney and turn this around. One of them is that the company changed the business strategy meaningfully and things get better. The other is it becomes a takeover candidate, which, I mean, one of these seems a lot likelier than the other one, at least to me.
It's a Bahamas to take over. I mean, it would take a ton of money, and somebody who wants to, get involved in that mess. But when we think about, okay, what would make it appealing? Yeah, takeover. Hard to imagine who the acquirer would be. I think it's a change of strategy, and a significant and dramatic one. I'm not sure current management, Iger, is really up for that. It's going to cause a lot of conflict. So, but those are the two things I think that could cause it. I think if the stock just fell apart, like went down a lot, it could be compelling.
Right.
But not at, with these levels.
And clearly you don't own it.
No, we don't own it.
Okay, just making sure.
Thanks.
And you're not short it.
We're not sure.
Okay, James, good to see you again. Thank you so much. Let's summarize what you're telling folks here. Buy Booking Holdings. It's a growth company that's reasonably priced. It has a well-built business model with a good moat. On the other side, you say avoid Disney. It's falling down the rabbit hole, from previous management. And the stock's overvalued, and it's facing drawbacks as it spent all this on streaming competition.